If you have money sitting in a savings account earning 2 or 3% interest, and inflation is running at the same rate or higher, your money is not growing. It is standing still at best and shrinking in real terms at worst. Investing is how you make your money work harder than a savings account can. Today we're covering what investing actually is, how compound interest turns small amounts into large ones over time, what you can invest in, how to start simply and cheaply, and the single most expensive mistake most people make, which is waiting too long to begin. Money sitting in cash loses purchasing power over time. Inflation means that £10,000 today buys less than £10,000 did 10 years ago. A savings account earning 2% when inflation is 3% is technically losing real value every year, even though the number on the screen goes up. Investing does not guarantee you will beat inflation, but historically, a diversified portfolio of global companies has returned an average of around 7% per year over long periods, well above the inflation rate and well above what any savings account reliably offers. The question is not whether you should invest, it is how to do it simply and sensibly. When you invest, you're buying a small piece of a business. When you buy shares in a company, you own a fraction of it. If the company grows and becomes more valuable, your shares become more valuable too. You can also receive a portion of the company's profits paid out regularly. This is called a dividend. Investing in funds, which pool money from thousands of investors to buy shares across hundreds of companies, means you are not betting on one company doing well. You're betting on the general direction of the economy, which over long periods has been upward. That is the core idea. You own a small piece of a very large number of businesses, and you benefit when they grow. Compound interest is the most powerful force in personal finance. Here is how it works. You invest £100, it earns 7%, so it becomes £107. The following year, 7% is calculated on £107, not the original £100. You earn interest on your interest, every year. The longer it runs, the more dramatic the effect. £200 per month invested for 10 years at 7% becomes approximately £34,000. For 20 years, it becomes approximately £104,000. For 30 years, it becomes approximately £242,000. The contributions total £72,000. The rest, £170,000, is entirely the result of compound growth. Time is the ingredient. The sooner you start, the more of it you have working for you. The most common mistake new investors make is trying to time the market, waiting for the right moment to invest, or pulling money out when prices fall. This almost never works. Studies consistently show that missing just the 10 best days in the stock market over a 20-year period can cut your total return by more than half. The problem is those best days are impossible to predict in advance, and they frequently follow the worst days. The strategy that consistently outperforms market timing is simply being invested continuously and regularly, regardless of what the market is doing. Time in the market beats timing the market. Every time. 4 main asset types. Shares. You own part of a company. Value goes up and down with the company's performance and wider market conditions. Bonds. You lend money to a government or company in exchange for regular interest payments. Lower risk than shares, lower return. Property, buying physical property or investing in property funds, can provide rental income and capital growth. And cash, bank accounts and savings accounts, lowest risk, lowest return. Over long periods, the historical data is clear. Shares have outperformed bonds, property and cash, but they are also more volatile in the short term. The right mix depends on how long you are investing for and how comfortable you are with short-term ups and downs. An index fund is a type of investment that simply tracks a market index, like the FTSE 100 or the S&P 500. Instead of a fund manager trying to pick winning stocks, an index fund just buys every company in the index in proportion to its size. No guesswork, no expensive research team, no high fees. The remarkable finding, backed by decades of data, is that around 85% of actively managed funds, the ones with professional managers trying to beat the market, underperform simple index funds over 10 years or more, and they charge significantly higher fees for doing so. For most people starting out, a low-cost global index fund is the simplest, most evidence-backed place to begin. Before you invest a single pound outside a pension, understand the stocks and shares ISA. It is a tax wrapper, a container that you put investments inside. Any growth, dividends, or interest earned inside the ISA is completely free of tax, forever. You can invest up to £20,000 per year into an ISA. Once the money's inside, it never gets taxed on the way out. Over decades, this tax protection is worth a significant amount of money. The alternative, investing outside an ISA, means capital gains tax on profits above £3,000 per year and income tax on dividends above £500. Use the ISA wrapper first, always. 5 steps to starting. 1. Open a stocks and shares ISA with a low-cost platform. Good options include Vanguard, Invest Engine, Free Trade, and Trading 212. 2. Choose a low-cost global index fund. The Vanguard FTSE All-World Fund or similar is a reasonable starting point for most people. 3. Set up a regular monthly direct debit, even £50 per month. 4. Do not look at it constantly. Short-term fluctuations are normal and irrelevant if you're investing for 10 or 20 years. 5. Increase the contribution whenever your income increases. The amount matters less than the habit. The habit matters more than anything. Pound cost averaging is a phrase that sounds complicated and describes something very simple. Instead of investing a large lump sum all at once, you invest a fixed amount regularly, say £200 every month. When prices are high, your £200 buys fewer shares. When prices fall, your £200 buys more shares. Over time, this smooths out the effect of market volatility. You're not trying to buy at the perfect moment because you are buying at every moment. This is the natural result of investing monthly via direct debit. Most people do it without realizing it has a name. It removes the paralysis of trying to pick the right time to invest, because there is no single right time. Risk in investing means the chance that your investment falls in value. All investments carry some risk. The key insight is that risk and time are linked. In the short term, 1 to 3 years, markets can fall significantly and may not recover before you need the money. In the medium term, 5 to 10 years, downturns have historically been followed by recoveries. Over 20 or 30 years, no diversified global fund has ever failed to recover from a downturn and go on to new highs. This is why the rule of thumb is, do not invest money you might need within 5 years. An emergency fund covers short-term needs. Investments are for long-term goals. Keep those two things separate and short-term volatility stops being frightening. The biggest threat to investment returns is not the market. It is your own behavior during a downturn. When prices fall, the instinct is to sell, to stop the loss. When prices rise rapidly, the instinct is to buy more urgently. Both of these instincts tend to produce worse outcomes than doing nothing. Selling during a downturn locks in a loss. Buying aggressively during a bull run means buying at high prices. The investors who consistently build wealth are not the ones with the best stock picks. They are the ones who stayed invested through volatility, kept contributing regularly, and did not let short-term noise change a long-term plan. Boring, consistent investing beats emotional, reactive investing every single time. How much should you invest? The honest answer is as much as you consistently can after covering your needs, your emergency fund, and any high-interest debt. A rough starting framework: if you have no investments yet, start with whatever you can manage, even if that is £25 per month. Getting started matters more than the amount. Once you're in the habit, aim for the 20% from the 50-30-20 framework. Once that is working, look at increasing the percentage with every pay rise. The specific number matters far less than 2 things: starting and continuing. A small consistent habit started in your 20s produces dramatically better outcomes than a larger amount started in your 30s. Here is the number most people never see. Someone who invests £200 per month from age 22 and stops at age 32, 10 years of contributions totaling £24,000, ends up with more money at retirement than someone who starts at 32 and invests £200 per month all the way to 65. 33 years of contributions totaling £79,200. More money, more years, but less outcome. Because the person who started at 22 had an extra decade of compound growth at the beginning. and that first decade is worth more than all the years that follow. This is the cost of waiting, not the money you fail to contribute, the decades of growth you fail to start. A few platforms worth knowing about for UK investors. Vanguard Investor, low cost, straightforward, good for beginners who want to keep it simple. Invest Engine, zero platform fees on ETFs, good for regular investors. Free Trade, commission-free share trading, clean interface, good for learning. Trading 212, zero commission investing, useful fractional shares feature. For pension investing, your workplace pension through salary sacrifice remains the most tax-efficient starting point. Combine that with a stocks and shares ISA for non-pension investing, and you cover most of what most people in their 20s need. 3 investing myths worth correcting. First, you need a lot of money to start. You do not. Many platforms allow you to start with £1. The habit of investing matters far more than the opening amount. Second, investing is gambling. It is not. Gambling is a zero-sum game where one person's win is another's loss. Investing in a broad index fund means owning a piece of the global economy, which has grown consistently over any long period in modern history. Third, you need to understand economics to invest. You do not. A simple global index fund requires no knowledge of individual companies, sectors, or economic cycles. Set it up, leave it alone, review it once a year. Good investing is genuinely boring. Open a stocks and shares ISA. Set up a monthly direct debit to a low-cost global index fund. Increase the amount when you can. Do not look at it every day. Do not sell when markets fall. Do not move everything into cash because a news headline worried you. Review it once a year. That is it. The people who make this complicated tend to perform worse than the people who keep it simple. The evidence is overwhelming and consistent. Simple, low-cost, diversified, long-term investing is the strategy that consistently wins, not because it is clever, because it removes all the ways a person can get in their own way. 3 investing mistakes that consistently cost people money. First, keeping money in cash inside a stocks and shares ISA without actually investing it. Opening an ISA is not the same as investing. The money sitting as cash inside an ISA earns almost no return and is not benefiting from any market growth. You have to actually select a fund. Second, panic selling during a market downturn. Every significant market drop in history has been followed by a recovery. Selling during the drop locks in a loss and usually means missing the recovery. Third, chasing last year's best performing fund. Past performance does not predict future performance. This is not a warning label. It is a statistical fact. Consistent index fund investing beats fund chasing over almost every long time period studied. Investing is not complicated. It does not require expertise, a large amount of money, or perfect timing. It requires a stocks and shares ISA, a low-cost index fund, a regular contribution, and the patience to leave it alone. The maths is on your side. The longer you're invested, the more powerful the compounding effect becomes. The biggest risk in investing is not losing money in a downturn. It is never starting, because the decade of growth you miss in your 20s cannot be recovered in your 30s. Start simply. Start now. Add more when you can. That is the whole strategy. That is it for the Money in Your 20s series for now. If you have watched every episode, you now understand ISAs, pensions, credit scores, mortgages, budgeting, tax, side income, and investing. That is the financial education most people never get. Share it with someone who needs it. Subscribe for what's to come. New videos every week.